Why patience is the ultimate investment skill. You know what's funny, Michael? The investing world celebrates action. Buy this, sell that, jump on the next trend. But when you study the people who've quietly built extraordinary wealth, you discover something almost disappointing. They spent most of their careers waiting.
Exactly. We live in a world that rewards instant gratification. Your food arrives in minutes, your messages are delivered instantly, and your entertainment never stops. Then, people enter the stock market expecting wealth to work at the same speed. That's where the psychology breaks down.
Investing isn't a test of intelligence nearly as much as it's a test of emotional discipline. Most people don't lose because they picked terrible companies. They lose because they couldn't sit still long enough to let a good decision mature.
Think about it. Every notification, every headline, every social media post whispers the same message: you're missing out. That fear of missing out, FOMO, is incredibly expensive. It convinces investors that constant movement equals progress, when often it just creates unnecessary mistakes.
Warren Buffett once joked that the stock market transfers money from the impatient to the patient. It sounds simple, but it's one of the deepest observations ever made about behavioral finance. Markets fluctuate daily, but great businesses create value over years.
Charlie Munger often emphasized the importance of waiting for exceptional opportunities. Most people can't do it because waiting feels unproductive. Yet patience is productive. It just doesn't look busy.
I once met an investor who checked his portfolio nearly 50 times a day. Every small decline felt like a crisis. Another investor reviewed hers once every few months. Guess which one slept better and earned better long-term returns?
That's because our brains confuse activity with control. We think making more decisions means we're improving results. In reality, decision fatigue often leads to emotional investing instead of rational investing.
Compounding doesn't only apply to money. It applies to knowledge, habits, confidence, and judgment. Every year you avoid impulsive decisions, you're compounding wisdom alongside your portfolio.
That's why I always tell new investors to create rules before emotions show up. Decide how often you'll review your investments. Write down why you bought an asset. Think in decades instead of days. Those simple habits protect you from yourself.
And remember, the market doesn't reward the loudest voice or the fastest trader. It rewards those who can remain calm when everyone else is reacting.
Patience isn't passive, it's active self-control. It's trusting sound decisions long enough for time to become your business partner.
In the end, investing isn't about predicting tomorrow. It's about preparing for the next 10 or 20 years with discipline and conviction.
Because the greatest returns often belong not to those who chase every opportunity, but to those who understand that time, not timing, is the ultimate edge.